Hi everyone, JP Morgan forecasts gold at $8,500 per ounce. Goldman Sachs says $4,900. Morgan Stanley predicts $5,700. Gold just crossed $5,600 and delivered a 64% gain in 2025, crushing every major index. Wall Street won't tell you this. While gold surged, SCHD dividend investors lost 23% during the worst tech crash in years, while the Nasdaq plummeted 33%. The cheapest gold fund I'll show you costs just 0.09% annually. The third piece is a portfolio blend that profits whether markets soar or collapse. Everyone tells you to pick a side, gold or stocks. That false choice destroyed portfolios in 2022 when both assets cratered simultaneously. Tech dominates for years, valuations expand, AI euphoria spreads, then cracks appear. The dollar weakens, tariffs escalate. Institutions abandon overpriced growth stocks and flee to hard assets, plus dividend-paying value companies generating actual cash flow. Gold recently hit $5,600 per ounce before pulling back. Central banks accumulated 755 tons in 2025. China slashed its US Treasury holdings to a 17-year low. India, Russia, Turkey, all rotating out of dollars into gold. JP Morgan's analysis shows investor gold allocations rising from 3% to just 5% could drive prices to $8,000 or even $8,500 per ounce. Meanwhile, SCHD climbed 8.5% year-to-date versus the S&P 500's meager 1% gain. Value stocks and dividend payers are finally outperforming after 3 brutal years, trailing tech. Small cap value surged nearly 6% while large cap growth stayed flat. Holding 100% tech stocks leaves you exposed when gold rallies wreck the dollar. Holding 100% gold means you miss 50% tech rallies. Stop choosing sides. Own both and adjust ratios based on your age and risk capacity. Position 1 is physical gold through ETFs. Call it the dollar destruction hedge. When fiat currencies weaken, governments print endlessly, and debt spirals uncontrollably. Gold becomes the ultimate asset with zero counterparty risk. 4 main options exist, and expense ratios compound brutally over time. GLD has a 0.40% annual cost. A $100,000 investment pays $8,000 in fees over 20 years, with $78 billion in assets. It's the most liquid choice for active traders, but expensive for long-term holders. IAU cost 0.25% with $32 billion under management. Better than GLD, but not the winner. GLDM runs just 0.10% with $25 billion in assets and razor-thin trading spreads. This is GLD's low-cost alternative. IAUM wins at 0.09%, the cheapest physical gold ETF available. iShares built this to compete directly with GLDM. Do the math. $100,000 in GLD over 2 decades costs $8,000 in fees. That identical amount in IAUM costs $3,400. You pocket $4,600 simply by choosing the efficient wrapper. Most investors should buy GLDM or IAUM. Rock bottom fees, strong liquidity, available everywhere. Gold delivered 140% returns over 5 years. Your $10,000 became $24,000. The 2025 return alone was 64%, obliterating the S&P 500's 14% gain. If JP Morgan nails their $5,000 year-end target, that's another 20% from current levels. In the aggressive scenario where gold reaches $8,500, you're looking at 72% gains from today's price. But gold generates zero income. It sits in vaults. Profits come purely from price appreciation. Retirees needing cash flow get nothing from gold alone. SCHD solves this problem. Position 2 is SCHD. I call it the income shield. This ETF owns 100 elite dividend stocks that maintained and grew payouts for at least a decade straight. SCHD's expense ratio runs 0.06%. A $10,000 position costs you $6 annually. The dividend yield sits between 3.8% and 4%, generating $380 to $400 in annual cash on that $10,000 stake. SCHD delivered 236% total returns over 10 years. $10,000 grew to $33,600, while quarterly dividend checks arrived like clockwork. That's a 12.9% annualized return, combining price gains and reinvesting distributions. The real magic? When the Nasdaq collapsed 33% in 2022, SCHD fell just 3.2%. Energy companies, healthcare giants, consumer staples, they held firm because they generate consistent cash flow and pay dividends regardless of tech stock chaos. SCHD currently allocates nearly 21% to energy. ConocoPhillips and Chevron are minting cash. Healthcare exceeds 16% with names like Merck and AbbVie. These defensive sectors outperform precisely when overvalued growth stocks implode and money rotates to safety. The rotation is underway. Value stocks are beating the S&P 500. Dividend payers are outperforming. The Russell 2000 small cap index beat the Nasdaq for 10 consecutive trading days, a 30-year record. SCHD gained 8.5% year to date, while the broader market barely moved. Critical warning, SCHD is not a growth rocket. From 2017 through 2021, growth stocks returned over 200%, while SCHD returned roughly 80%. You nearly doubled your money, sure, but left massive gains on the table if you held dividends exclusively. Allocation isn't optional. It's the difference between retirement and working until you're 75. Think about this. If you went 100% to SCHD in 2017, you missed tech's 200% run. If you went 100% tech in 2022, you lost a third of your money. If you went 100% gold from 2013 to 2018, you watched it go nowhere for 5 years. Every single asset strategy has catastrophic blind spots. The institutions get this. They're not betting everything on one horse. They rotate, they hedge, they sleep at night. Position 3 is the exact allocation that wins during both gold surges and dividend rotations, and I call it the cycle-proof strategy. Ages 30 to 45, allocate 30% to SCHD, 50% to VOO or VTI, 15% to GLDM or IAUM, and 5% to growth positions. Volatility doesn't matter with 3 decades ahead, but hedges protect against catastrophic crashes. Ages 45 to 55, shift to 35% SCHD, 40% VOO or VTI, 20% GLDM or IAUM, 5% bonds. Stock exposure decreases as retirement nears, while gold allocation rises to guard against currency debasement. Ages 55 to 65, move to 40% SCHD, 30% VOO, 20% GLDM or IAUM, 10% bonds. Major drawdowns before retirement are catastrophic. SCHD's dividend income starts replacing your salary, while gold preserves purchasing power against inflation. Ages 65 plus, position 50% in SCHD, 20% in VOO, 20% in GLDM or IAUM, 10% in bonds. Capital preservation and income generation become paramount. A 30% market crash at 70 destroys retirement. SCHD pays you regardless of market conditions, while gold protects against monetary collapse. During tech booms, your VOO stake captures explosive growth. During rotations and crashes, your SCHD position pays steady dividends from defensive stocks. When the dollar weakens and money printing accelerates, your gold position soars. Across full market cycles, you earn strong returns with dramatically less stress than single asset gamblers. Central banks are abandoning dollars for good. Dividend stocks are rotating into favor. Tech valuations remain dangerously stretched. Predicting crash timing is impossible, but positioning for any outcome is simple. This isn't theoretical. Real portfolios using this strategy dropped 8% in 2022, while the S&P 500 fell 18% and the Nasdaq crashed 33%. The same portfolios captured 85% of the upside during tech rallies. That's the power of diversification done correctly, not the fake diversification of owning 10 different tech stocks. SCHD delivers 4% yield with defensive sector positioning. GLDM or IAUM provides pure gold exposure at minimal cost. VOO captures broad market performance. 3 funds, age-appropriate allocation, annual rebalancing. Stop chasing momentum. I analyze these strategies constantly so you stay ahead. You want to maximize tax-free gold and dividend income inside a Roth IRA? Building a true recession-proof portfolio? My next breakdown shows you exactly how. Subscribe now so you're positioned correctly before the next market cycle hits. Here's a disclaimer. This content is educational, not financial advice. All investments carry risk, including potential loss of principal. Consult a qualified professional before making decisions. This is Invest ED, building wealth the boring way that actually works. So smash that like button and subscribe for strategies Wall Street won't tell you. Smart investing, profitable results.